So guys, in this video I'm going to be talking about stop loss and take profit placement. Now you can do this two ways. Either you can use fixed stop loss and profit target, or you can use volume based stop loss and profit target. So in the first part of this video I'm going to be talking about the fixed profit target and fixed stop loss. So what this basically means is that you set hard stop loss and hard profit target, which is fixed number. So for example, if you are trading Forex, then you can have, for example, 10 pip profit target and 10 pip stop loss. Now, how to determine what the distance of the profit target and stop loss should be? Now, let me show you a universal method how you can determine that. So first, what you want to do is switch to daily chart. And you want to load a lot of days, like 500 days. So let's load 500 days. Currently I'm on the euro dollar, but I'll show you another trading instruments, alright? So I loaded 500 days, and now I go into indicators and I open up the ATR indicator, this one. As you can see, I already have this loaded up. So this is the ATR indicator, and this shows you the daily volatility, the average daily volatility. Now you want to set a high period. I set it for 200, but you can go for more. Maybe you can use, for example, 400 period. Press OK. This is the ATR right there. And if you look at this 500-day period, you will see the average number. You will see the average daily volatility. As you can see in here, it goes a little bit downwards from around 80 pips to 70 pips. In fact, it's not that much. It's just 10 pips. All right. So this is the average daily volatility. If this number on the right side shows 0.0082, somewhere in here, then it means daily volatility is 82 pips. All right, that's average daily volatility at this level. So let's say that the average of this whole area is somewhere in here, around 80 pips per day. All right, so average daily volatility is 80 pips per day. And what I suggest is for intraday trading, you use 10 to 20% of the ATR, the average daily volatility, as your take profit and stop loss. So in here, the average daily volatility on the euro is 80 pips, and 10% of that is 8 pips. So you want to be trading with 8 pip take profit and 8 pip stop loss. If we want to use the 20%, 16 pip. All right, so this should be the range for your fixed take profit and stop loss. All right, that's the ideal range for that. Let me show you the same thing on some other trade instrument. Let's go, for example, to US dollar Japanese yen. Again, I loaded 500 days. As you can see in here, the volatility has increased drastically. What you can do to soften up this ATR a bit is to use longer period. So we go to indicators and we can use higher period, for example 800, and we load more days. So let's load 1000 days. As you can see now, the ATR, the average daily volatility, is more smooth, and it ranges from 88 pips per day to 76 pips per day. All right, so the average is somewhere in here, around 80 pips per day. All right, 80 pips is the average daily volatility. So again, take profit and stop loss would be somewhere around 8 to 16 pips. Let's now have a look at the ES, which is futures for Standard & Poor's Index. In here, the average daily volatility is somewhere around 28, which means that your take profit and stop loss should be somewhere around 2.8 to 5.6 points. Alright, that should be your ideal take profit and stop loss if you go to use the fixed one. Now let's do one more instrument. Let's go to the crude oil. Again, all those are daily candles, and in here average daily volatility is somewhere around 1.5. So the ideal stop loss and profit target for the crude oil will be in the range between 15 to 30 points. Now those were just rough numbers. Of course you can use any range you want, any range you are used to, but this is the way which I prefer to use. So for example, for all the forex pairs, for all the major forex pairs, I personally use 10 pip take profit and 12 pips stop loss, which has a slightly negative risk-reward ratio. So what I suggest is that you use the 10 to 20% of the ATR. The nice thing about that is you need only once to study the ATR, to look at the numbers, then you write it somewhere down so you always know what the take profit and stop loss is, and you never change it. Of course, if the volatility doesn't dramatically increase or decrease, you can stick to the same numbers. So for example, I trade with the same stop loss and profit target for around 3 or 4 years, and I haven't changed it since. So that's the cool thing about having a fixed stop loss and take profit. You don't need to think about it, it's automatic, and it's super easy. Now, having fixed stop loss and take profit doesn't mean you don't manage your position, alright? You can manage it, but I'm talking just about the initial take profit and stop loss, alright? Now, apart from the fixed take profit and stop loss, you can also use volume-based stop loss and a take profit. So let me change the chart to a 30-minute time frame. Alright, so this is the euro-dollar 30-minute time frame. And the first I'm going to show you where to place your stop loss using volumes. So the main rule here, the rule of thumb, is you always want to place your stop loss in a low volume area. So imagine, for example, here that you went long from this volume cluster, you went long from there, and your stop loss for this trade should be in the low volume area. So this was the long level, and if you look at the profile for this whole uptrend, then this is the place where volume-based stop loss should be. Low volume area. This is where the heavy volume cluster ended, and very low volumes are in here. Now the reason for that is that heavy volumes work as a strong support and resistance zone. So this was strong support and resistance zone, and this whole volume cluster is strong zone, alright? So the price shouldn't go past it. If it does, if the price enters in a low volume zone, then this area, this strong support, did not really work, and you don't really want to be in that position anymore. That's why you quit at the low volume area. So let me show you some more examples. Let's have a look, for example, in this trend. Let's use the profile like this. So if you use the trend setup and have a long entry level in here, then your stop loss would be below this volume cluster. So it could be either in here or in here. Alright, at the place where the volumes are low. Now let's have a look at this example. Let's say that you went long in here based on this volume cluster, alright? The setup was based on this volume cluster. Now you want to place your stop loss in a low volume area. So in this case, it could be either in here. Let me draw a straight line, that would be better. Or in here. This is where the low volumes are. Those low volume areas which are below this volume cluster. Now, what you should also consider is the volatility of the instrument, because if you entered at this level, which is 1324, and had stop loss at 1321, there would be just 3 pips, and that's not really enough for a trade to breathe. So in case like that, you want to place your stop loss further. Either you can use fixed stop loss, or you can search for area like this, another low volume area. So in this case, if I went long from there, then my stop loss would be this one at 1316, which is around 8 pips from the trade entry. By the way, that's 10% of daily volatility. Alright, so that's stop loss wide enough to let your trade breathe. Let me switch the instrument now. Let's go and have a look to the ES. So let's have a look, for example, in here. Let's say that you used this area to go long. Volume accumulation setup in here. So you go long from there. And the ideal stop loss for this trade, based on the low volumes, would be, in my opinion, in here. It could also be in here, but the stop loss in this case would be just too tight, alright, as in the previous case. So you always want to pay attention to that. You don't want to use too tight stop loss. So in this case, I would use this low volume area to place the stop loss for this long. Now let's, for example, have a look at this trend. There are nice levels to go long from in here, and in here. Those are nice volume clusters to go long from. That's the trend setup, alright? This is one volume cluster, another one, another one. So those would be levels to go long from. And the ideal stop loss for the first long could be either at this area or at this area. I would personally choose this one to let the trade breathe, alright? Now, let's have a look at the second one. The second long level, this one. So if you look at the profile, then the ideal stop loss for this trade would be somewhere in here. This would be the ideal stop loss in this low volume area. And if you look at the third long level, which is in here, then the ideal stop loss would be in this low volume area. This is the low volume area, and this is the ideal stop loss. So what you can also do is to use this approach as a trailing stop loss. So let's say that you are in a long position from this area. You are in a long and you are trailing your position. So you are moving your stop loss, alright? As the price goes upwards, you always want to move your stop loss below the volume cluster. So first, secure your position in here. Then the price moves higher, you secure your position below this volume cluster. So you move your stop loss in here. The price goes higher again, you place your stop loss below this volume cluster. Again, the price goes higher. You can move it below this volume cluster, then below this one, in here, then somewhere below this one, and then, as the price advances further, I would secure my position below this volume cluster, in here. And that's where I would take the stop loss. Right there. This is where the long position would end if you used the volume profile to trail your stop loss. So you always want to move your stop loss below heavy volume areas, alright? No matter if you are trading your position or if you are just using volume profile to place your hard stop loss. Alright, so remember, the rule of thumb here is stop loss goes into a low volume area. That's the main idea behind this approach. Alright, this is important. Now let's talk a bit about volume-based take profit. The main rule here is that take profit goes into a heavy volume area. Alright, this is important. And it's basically the opposite to the stop loss, because stop loss goes into a low volume area and take profit goes into heavy volume area. Reason for that is that heavy volume areas are strong support and resistance zones. And when the price gets into heavy volume area, there is a risk that the price will reverse. Alright, and you don't want to risk that, so you quit your position. So let me show you some examples of that, alright? So for example, in here, let's imagine that you went short from there and you are searching for ideal place to take profit. So what you do is you use the flexible profile like this, and heaviest volumes in this pullback area are in here and in here. So what you can do is you can quit your selling position in here or a little bit above this level, or above this level. Alright, so those are two possible take profits. What you can also do is you can split your position. You can, for example, take first half of the position in here. You can exit it in here. So this is take profit number 1. And in here, second half of the position, take profit number 2. As you can see in this case, the price didn't react to the first volume cluster, but it did react to the second one. And from there, it turned and went upwards. Now, for example, in here, let's say that you are short from there and you are looking for a place to quit your position. So you use the profile over the pullback period, and you see that heaviest volumes in this area were right there. So this is where you quit your position. The reason is this area could work as a strong support. So it is pretty risky to go past it, to try and trail your position past it. So that's the reason you want to take your profit at this level. Alright, so you went short from there, and in here you take your profit at the heavy volume area or a little bit above it, so you can actually close the position somewhere in here. Now, for example, in this case, let's say that you went short from there, and the ideal take profit for you based on the volumes would be at this heavy volume peak right there. This would be the ideal place for a take profit at heavy volumes, or a little bit above the heavy volume zone, because this again could work as a strong support, and it would be risky to try to hold your position through this support. All right, as you can see in this case, the price reacted to the support, so this was really a good place to take your profit. Now let's say that, for example, in here you went long and you are searching for a place to take your profit. So you use the volume profile like this for this pullback area, and the heavy volume cluster in here is this one, very nicely visible. And you definitely don't want to go against this volume cluster. So if you enter somewhere in here, you are in a long position, you see this heavy volume cluster, then this is where you want to take your profit, or a little bit below the volume cluster, a little bit before the price actually reaches it. All right, this is where you want to exit your position. Also, for example, in here, if you went long from this area, then the ideal place to quit your trade would be in here. All right, based on this volume cluster, heavy volumes in here. Now, one more example. Let's say that you went short from there. You are in a short position and you are looking for a place to quit your trade. So you use the profile over this whole pullback area for the whole pullback movement. The first significant volume cluster is this one, so you want to quit your trade before the price reaches it. So you draw a line there, a little bit before the price reaches it, you quit your trade somewhere in here. All right. Now what you can also do is you can trail your position. For example, take profit in here, then the second one in here, and also what you can do is take a third part of take profit and take it in here. All right, at those three levels. You can do it also like that. Now, to determine where to place your stop loss and take profit, I recommend using the primary chart. In this case, for me, it is the 30-minute chart. This is the chart which I use for my intraday trading analysis. So this is the time frame, this is the chart where I also determine where I place my stop loss and take profit. All right, so don't switch to lower time frames or to higher time frames. Stay within the same time frame you use for your trading analysis. All right, so that's basically it for this video. Let me do a very brief recap for you guys. The main rule, which I really want you to remember here, is that stop loss goes into low volumes, low volume area, and take profit goes into heavy volume area. All right, this is the most important thing from this video. I hope you remember it. This is a pretty cool thing, how to place your stop loss and take profits, and I think that you definitely should give it a try, and I'm pretty sure that you'll like it very much. All right, so that's for this video, and I'll see you in the next one.